If you've been following my channel, then you know I've been covering the electric vehicle space for quite a while, and I've said many times how it's been overhyped. With current events causing investors to reevaluate these stocks, we're now seeing corrections. But with rising oil prices, there are still practical reasons to be moving away from internal combustion engines, and the EV industry should offer a good investment. I've just recently moved into an electric vehicle myself, and I'm already saving a fortune at the pumps. So I wanted to give a renewed perspective on the industry and where I think an investment opportunity still exists, with one particular company trading under the radar and at a discount despite growing returns. Here we go. As I've covered in previous videos, the EV industry has been hyped up too many times, with too many companies overvalued, flying high before crashing down as they miss their projections. There's just so much volatility and risk right now, and frankly, I'm bored of them.
I have had enough of you!
Still, with government targets to reach net zero by 2050, a ban on internal combustion engines by 2030, and rising oil and energy prices, customers need a viable alternative. And that's without discussing the level of development needed to build the charging infrastructure. Now, if you want a summary of what's been happening to EV stocks over the last couple of years, it's essentially EV manufacturers being overly optimistic about the projections, and when the realities of production came to light, namely overrated manufacturing capabilities and the shortage of materials, particularly battery minerals and computer chips, the stocks have reacted badly. Rivian, for example, was hyped up and failed to reach their very modest production target of 1,200 vehicles for last year. Lucid has also missed their production targets, and Tesla has had to cancel the Cybertruck for 2022. Ford are still pushing high projections as they plan to go electric and exceed Tesla, which would mean even more competition for components. Volkswagen seem to be a more solid investment, but I've pulled out due to volatility over the majority owners trying to sell their stake to fund a Porsche IPO.
Hey! Let's push up!
As a result, I've lost interest in continuing to cover these same companies when the optimistic projections have already been priced in, and the volatility is likely to continue as supplies fail to meet demands. Instead, I'm focused on how the push towards electric vehicles has benefited and caused a shake-up in new and used vehicle sales. Historically, new vehicles lose around 10% of their value as soon as the keys are handed over, followed by a further 15 to 20% by the end of the first year, then around 15 to 25% every year thereafter. And this adds to the reason why many drivers, such as myself, never buy a new car, as you can easily save around 20 to 30% buying used. And typically, a 5 to 10 year old combustion vehicle would still be in pretty good condition, with reasonable emissions and decent fuel mileage. But when it comes to electric vehicles, the initial loss on purchase is higher, partly due to how they benefit from various government tax credits on new models, which are yet to be extended towards used vehicles, so they are susceptible to a massive drop in value after initial purchase. Anand Kulkarni, product line director at Tata Motors, that's the owners of Jaguar Land Rover, suggested that the acquisition cost of an EV is around 15 to 20% higher than a standard internal combustion engine vehicle, and the first year depreciation is around 20 to 25%, but it holds more value to the used buyer, who benefits from the cost per mile being 1/6 of a combustion vehicle. But as recent events have highlighted, the politics are turning against combustion engines. Fuel prices are rocketing, and governments continue to introduce new methods of taxing them, such as road tax hikes and green climate zones. Even now that I own a hybrid, I recently travelled to London and had to pay £15 for an ultra low emission zone fee just to drive 2 miles into the city. My hometown of Bristol are introducing a similar green zone, but fortunately I currently qualify for free entry. But I think it's only a matter of time before the rules change, and anyone not driving a fully electric vehicle are going to get fucked. If we take a look at current EV models, ranges are at an all-time high, with Tesla and Lucid leading the way. The Lucid Air in particular has a range of 520 miles, so range is not much of an issue. But as many already know, much like mobile phones, a key issue when it comes to technology is the quality of the battery, and that determines the lifespan of these vehicles, not the initial range. So realistically, initial range isn't too much of an issue. Battery Life, an EV enthusiast and YouTuber, range tested a Volkswagen EV over its first year, averaging 90% battery capacity, and found that the battery lost 7.5% charge. They approached the brand, and a service centre conducted a similar experiment and found 8% capacity degradation over 14 months, which represents around 6.9% degradation over 12 months. Volkswagen stated their recommendation for prolonged battery life is to keep them charged at around 20 to 80% instead of 100% and use regular charging, not rapid. They estimate that their batteries should last the lifetime of the vehicle. If we take the resulting estimates as somewhat accurate, assuming it's either a relative 6.9% a year, meaning degradation slows down, or 6.9% of the original charge each year, it's clear that battery degradation is pretty significant. Still, the majority of manufacturers include a warranty of around 8 years and 100,000 miles, so this degradation is well within what they might consider a vehicle's lifetime, but is not so great for the used car market. A 10-year-old car at 31% capacity doesn't offer much by way of utility or financial value for customers. A big problem lies in these manufacturers designing the chassis of their vehicles around the battery packs, meaning replacing them is unviable, especially when it comes to older vehicles. So when many companies are projecting massive EV sales, such as Tesla, flooding the market with almost 1 billion sales last year, what happens in a decade when all these vehicles lack any utility due to the drop in their battery range? We could be looking at a time bomb, where a sudden influx of electric vehicles are likely to be scrapped because of their battery state, and it's more cost effective to dispose of them and buy another one. It certainly questions just how carbon friendly these electric vehicles are going to be in the long term. Fortunately, some vehicles hold value better than others, such as a Tesla Model 3, which seems to be doing very well against the competition, with one theory being that their continuous software updates continually improving the car, whilst the brand continue to push towards new battery technologies, such as the idea of a lithium-ion battery. Volkswagen have shown interest in solid-state batteries, specifically with a $300 million investment into QuantumScape, who have also had interest from other auto manufacturers. Solid-state batteries are a concept that's been in development for over 70 years, but recently became massively relevant because of electric vehicles, due to being lightweight, less susceptible to climate temperatures, and the potential of charging a vehicle within around 10 to 20 minutes, compared to lithium-ion batteries that start to degrade and lose power after around 1,000 cycles. Solid-state batteries retain 90% of capacity after 5 to 10,000 cycles, providing a lifetime of around 10 to 15 years. Problem lies in the introduction of this technology into wide-scale auto manufacture. If you are interested in a speculative play in this industry, I have taken a minor investment in Solid Power, who are focused on the very issue of mass production, and I think offers a more realistic approach than QuantumScape. There's also Toyota, who are working on this issue and hold a significant number of patents in the technology. But I'm not going to go into this in too much detail because I think it's a very speculative play. News on battery technology is changing rapidly, and it may be years before they end up showing up in a vehicle. But if I'm right and Solid Power get their batteries into a mass production vehicle, it just might pay off my mortgage. So my point is that when you understand the concerns in the EV market from a customer perspective, there's a certain advantage in leasing a vehicle, providing all the benefits of electric vehicle ownership without the negatives of depreciation in price and battery capacity. Or you could buy used, where a large portion of depreciation has already been priced in. And there's one industry that does just this, and that's the fleet leasing business. Leasing companies have the benefit of operating with large vehicle fleets, with clients who tend to be big companies requiring large fleets of vehicles for their employees or customers. As these companies are being pushed to transition away from combustion engines into green alternatives, fleet companies offer an all-in-one solution to build in their fleet without the large short-term impact of buying vehicles themselves, or the long-term responsibility of maintenance before selling on. Leasing companies benefit from this arrangement as they make a profit on new vehicles for their clients, with prices already factoring in future depreciation, and when those contracts expire, they can sell the vehicles on to the used car market where they can make further profit. If you ever wondered how the largest used dealerships get their stocks, this is typically the case. With companies being pushed to convert their fleets, current reports project the auto leasing industry to grow by 14.2% this year, and then 13.3% each year to $717 billion by 2026. As leasing companies offer various different brands, they have all the benefits of a growing industry without suffering the same volatility as individual auto manufacturers. There aren't many leasing companies available on the market, but of the few available, the one I think offers the greatest opportunity for investors is ALD Automotive. Here's the breakdown. ALD Automotive are part of the French company Société Générale and a global leader in mobility solutions, offering fleet management services across 43 countries to a huge clientele of large corporate companies, professionals and private individuals. Over the last 20 years, the company has been executing a long-term investment strategy of partnerships and acquisitions focused on sustainable mobility for businesses. From their portfolio of 298,000 vehicles in 2001, they have averaged a compound annual growth rate of 8%, up to 1.5 million vehicle contracts at their IPO in 2017, expanding to 1.726 million as of today, ranking them one of the largest leasing companies in the world.
It's coming in nicely.
From their 2020 reports, they recognised a growing demand in green vehicles and set out their goal to lead the industry in a transition from diesel into green passenger vehicles, and formed a partnership with Tesla and Polestar to build the fleet and the charging infrastructure. Last September, they acquired 17% share capital in Skipper, a Belgian mobility as a service startup which specialises in providing management services for companies offering mobility solutions to their customers. In October, they acquired Fleetpool, the leading German car subscription service, for their digital car services in Europe, with the goal of reaching 2.3 million contracts by 2025. In January, they announced their intention to acquire their largest competitor, LeasePlan, for 4.9 billion euros by the end of the year, which will increase their vehicle management target to 3.5 million vehicles for 2022. They also appointed EO Charging to provide their charging infrastructure, including installation of smart charging solutions for their return to home fleet customers, which includes Amazon in the UK and Ireland. Expansion is great, but recently the stock has tanked 23% from their 32-week high. So the question is this due to company performance, recent world events, or does this present a genuine buying opportunity? Well, this is where the financials come in. Having gone through years of ALD reports and collected their earnings, what we have here is some pretty clear performance, particularly over the last couple of years, since it was in 2020 that they increased their focus onto electric vehicles. They have shown continued growth in their EV and green fleets, which represent 30% of passenger cars in Q4 and 27% of 2021, compared to 18% in 2020. With internal combustion engines down to 53% for the year, it shows demand for these vehicles is falling rapidly and EVs are filling the void. From their Q4 and 2021 report, they announced that their fleet grew by 4% despite delays in deliveries due to semiconductor shortages, but they have been able to counteract this by capitalising on the high demand and short supply of used vehicles, reaching record used sales volumes the same year, completely disposing of their 2020 stock and making almost 5.5 times more profit on their sales. Operating income is up 38.2% year on year, representing a 21.2% increase in their leasing contract margins and a 615.9% increase in their used car income. If we look at their three main income streams, we can see that used car sales is their highest area of growth, particularly during 2021, with leasing coming in second, and this adds to 15.5% shareholder equity, which has been growing at a consistent pace. Servicing revenue is somewhat stagnant, but factoring in the increase in sales in EVs, which cost less to maintain, I would have actually expected a drop. So maintaining the status quo is actually a positive. We can see that their asset growth is actually substantial compared to the competition, a clear result of their investments, partnerships and acquisitions, and likely to make a massive jump once they complete their LeasePlan acquisition this year, which will place them at the top of the industry and more than double the size of their next rival, Arval. ALD are backed by their decent financial ratings, and from their Q4 earnings, the company announced an annual dividend of 1.08 euros per share, which represents a yield of around 5.54%, and particularly good news for investors who love a dividend. For their future outlook, they expect to grow another 4% in fleet size, above 1,000 euros for vehicle sales margins, which is more than double their rate in 2020, and they have enough steady income to maintain their dividend long into the future. As for the metrics, there's only a small number of these companies on the market to compare, and ALD trades at around €12, having recovered by 6.54% this week alone, and that's still just 5.59 times earnings, 0.47 times sales, and that makes it cheaper compared to the rest, and the latest analyst sentiment has given it around 50% room to grow. The EV market is full of optimism, but buying into this industry has proved risky for investors as many companies have been hyped up by the media and are yet to deliver on their projections, due mainly to a shortage of supply of key manufacturing materials. The leasing industry has the advantage of being somewhat impartial, able to sell any brand of vehicle available and work with companies desperate to modernise their large fleets and keep up with the latest EU emission standards. ALD has done well to focus on this evolving market and have become a leading contender. The stock growth over the last 2 years was earned through their exceptional growth in EV and used car sales. The recent drop in stock price has undone about 18 months of this growth despite delivering exceptional earnings, and this seems to have been a reaction to the Ukraine issue at the moment, where investors are pulling out of any EU stocks and essentially throwing out le bébé français avec l'eau de bain. I took advantage of the recent drop to buy more, and ALD currently stands at around 7% of my portfolio, and at these levels it remains a great buying opportunity for investors looking to capitalise on the current bearish market. Or those like myself who are turned off by the volatility in the EV industry and would prefer a more stable entry. So that's my take, and if you like what you see, please remember to smash that like button, and if you have any thoughts on an investment you think I should be covering, please comment below, let me know. And then as I continue to cover my entire portfolio, you might want to consider subscribing so you don't miss out on future videos. Until next time.